Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, October the 7th, 2025. Recording this in the morning as always. Just noting the date here, October the 7th, that of course is the 2-year anniversary of the Hamas attack on Israel, which of course has had a huge effect on Middle Eastern politics. Nothing in particular, but just interesting to see if there's any particular sort of headlines or news coming out of that. We know that Hamas and the Israelis apparently are negotiating in Egypt. So hopefully there'll be an end to that conflict very soon. Okay, in terms of other news, we still have the government shutdown. Apparently, there's a little bit of sort of behind the scenes negotiating, but still the Democrats and the Republicans have not been able to come to any kind of agreement. So we have no government data. If you actually look here, and see, we don't have a lot of data on the board anyway, but it looks as though we may not get initial jobless claims. There's not really much happening at all. So the market's been very, very quiet, and essentially volatility has gone down. And I thought I'd just pull up a few volatility indices here, and you can see that in general everything's sort of headed to pretty low volatility. Look at the VIX in the white here. The VIX, trading at about a 16 and a half handle, so that's down a lot. Look at the move volatility index for bonds in the blue here, and you see that that's also at lows. And then if you look at general, the CVIX, which is the currency volatility, you can see that currencies and the FX market, this kind of sort of pink apricot color here, is also very low. So volatility are very, very low. Just a lot of instruments just trading within a range, just waiting on sort of data. It's very difficult to know what the Fed will do because the Fed is said as data dependent, and in the absence of any data, the market is in a kind of a holding position, especially things like FX and the short-term interest rates and the bonds, very, very sort of low volatility. What we do have the New Zealand sort of interest rate decision. So let's have a quick look at that. We have that to actually just while we're here as well. We also have government bonds today. We have a 3-year auction at 1 o'clock. That should be well supported, but it will be interesting to look at that just to see whether, whether sort of foreign buyers are still interested in US bonds. So we have a few bond auctions this week. In terms of New Zealand, you can see here just looking at let's just look at the central banks here. For the Fed, we've still got that pricing in 23 basis points cut in October. So still one cut, still fully priced in. And the logic is interesting. It's like, well, how can the Fed cut with no data? But the problem is for the Fed is that, let's say the data, once it is released, shows a very weakened labor market, and if they haven't cut, there would be sort of some concern that they were behind the curve. On the other hand, maybe they will be cutting in late October. What do we have here? The 29th of October, and maybe the data will come out and show a pretty strong labor market and a strong economy. And then we'll have a situation of the Fed sort of throwing gasoline on the fire, basically a relatively robust economy with the Fed which is cutting interest rates, which could start leading to sort of potentially a reignition of inflation and whatnot. But let's just get back to New Zealand. So the market's expecting New Zealand to cut here. You can see here 36 basis points. So at this point, the effective rate is 3%. So still, not as low as, for example, the ECB, less than the US. But the New Zealand economy does seem to be relatively soft at the moment. And you can see here that 1.5 cuts are priced. So this is a pretty interesting one because we're between 1 and 2 cuts. And basically, I was looking at I think it was a Reuters survey of economists. It's 50-50 here in terms of what the market expects here. So it could be just 125 basis points cut or a full 50 basis points cut. And if you look further out, quite a significant cutting cycle is penciled in by the market. We see going all the way just the last meeting in November because you have the big summer holiday down in New Zealand. So, but you see here going into the beginning of 2026, almost 3 cuts are priced in. So a fairly aggressive a sort of cutting cycle. And it's very interesting. It's 36 basis points here. So let's have a quick look and just look at the New Zealand dollar here, just to put that into context we'll put it against the US, if I can find it. Yeah, here we go on the spot. So you can see that the New Zealand dollar overall sort of a trade range, but basically breaking down below this trade range here, got to a Fibonacci level, had a bit of support. But if they do cut by 50 basis points, you have to think that there's a retest down here is possible. But of course, it will depend on the forward guidance and whether they sort of support the overnight cash rate, the forward guidance supports what the market is as pricing in. As I said, about three more cuts priced, including tonight over the next 3 or 4 months or so. So the New Zealand dollar weakening a little bit. Let's keep an eye on that one. That's tonight, after the market closes in the US. In terms of other stuff, looking at just while we're on the currencies here, we have the dollar index quite supported. You see, yesterday pushed up on the back of the news out of Japan and to a certain extent also the political instability in France. It gave a little bit back, but as you can see this morning, the dollar index pushing higher. About 57% of that is euro. I think about 11 or 12% is the Japanese yen. So both of those currencies are under a little bit of pressure, and you have the dollar index here pushing up. But as you guys can see here, a pretty key level, in fact, a very, very important level here at about 98.5, 98.65, something like that. You see here, so the dollar, it will have to, if it wants to go higher, will have to sort of push through there. And if we just put on the shorter term fib here, let's just throw on the fib. You can see that also coincides to the 61.8 level. So that level there at about is like 98 and what is it, three quarters, 98.75. Very, very important level. You have to say if the dollar pushes strongly through there, it could push up, maybe even up to this sort of key 100 level. And why is that? It's not so much that the US situation is supportive, because we know we have a shutdown in the US, and that could be a problem if the US shutdown continues for another week or even 2 weeks. There could be some concern that that's going to start affecting the GDP. And Trump's talked already about potential mass layoffs of government workers. So at a certain point, this shutdown, which the markets generally have ignored over the last 4, 5, 6 years, if this one continues, as I say, for a multi-week period, that could start affecting sort of outcomes for the economy in terms of the GDP levels, which could actually negatively affect the US dollar. So I'm going to be quite curious to watch this level here and see if the US dollar pushes above. But one thing to keep in mind is that there's no data at the moment, and keep in mind that if you annualize the cost of being short, so like the carry, like remember, if you're short the US dollar, you're paying sort of a negative interest rate on that. That's over about 4.15% per week, sort of on an annualized basis. Obviously, that's not per week. On an annualized basis, we're over 4%. So per week, that starts getting very expensive if you're holding shorts, and you certainly don't want to be adding to your short in the US dollar. Because remember, if you're shorting against another currency, and so you have to be paying that that rate of over 4.15% per year. And I just wonder whether some of this is positioning, maybe institutions thinking, hey, we don't want to add to our shorts, or we don't want to actually be particularly short that much, or let's lighten up the position in the absence of data, just to avoid the carry costs there. So that's kind of quite an interesting sort of aspect here. And just keep in mind that, as I say, no data, no movement, no volatility. Holding a short in the US dollar here is actually just quite expensive. But most of the action here is because of the euro and the yen. We know that in France, there's been political instability. We saw that the prime minister resigned. I think it's the fourth or maybe even the fifth prime minister going back, 6 or 8 months or so. And if we just look at the euro here, let's just throw up the euro. USD, you can see that is actually starting to feel a little bit of pressure. Again, some of this is the US dollar just having a bit of support, maybe, as I said, because of the carry cost and no data and the situation in Japan. But nonetheless, the euro here is weakening a little bit. And if we also look at the bonds, if we go and have a quick look here at the OATs, which is the French 10-year, you can see here there's a big fall off when Le Cornu, the previous prime minister, resigned. And that is continuing here. We're still having a bit of red today. So the French bonds here sort of pushing lower. And if actually we look here more at the spread, you can see here that the spread, I mean, it's not at those most elevated levels, which is about 88 basis points, but you can see here that the spread of the French 10-year over the German is still pretty elevated. You're in, 85, 86 basis points. And basically what's happening there is that the French president, Macron, has given Le Cornu, the outgoing prime minister, until tomorrow night, so Wednesday night, a bit of sort of a deadline in terms of negotiating to reform a cabinet with members who would be more acceptable to both the extreme right wing and the left wing socialists. But you have to say, if he's unable to form that cabinet, and what could happen is that we may have either Macron resigning, which is low probability. That would be terrible for the French bonds and the euro. but that's a low probability event. We may just have another election, or we may just have some kind of technocrat, temporary prime minister. Anyway, the point is that the market has noted that. And it's just interesting you see here that this is the French yield over the German yield, and just compare that, for example, compared to for the Italian yield over, which is a very, very low here, is about the same now. So this is really, working towards the benefit of comparatively of the Italian bonds. And if you actually look here at the Italian bond spread, which historically has been a lot more than the French, now basically it's zero. So they're on a parity there. So anyway, the point is that the euro is still under a little bit of pressure. I'm just going to grab some tea here. And at the margin, that is supporting the US dollar. As I say, I don't know that it's necessarily sort of independent strength of the US dollar. If we also look at the yen here, so let's look at the yen. This is the USD JPY. See, again, the US dollar is showing a bit more strength, getting up now to a very key level, which is, let's just get rid of that one. A very key level here, which is about the 150 mark essentially. You can see that there's been a lot of sort of support or resistance over the recent sort of year or two. So a very whoops, sorry. Uh, Hold on, sorry. I think I just let me go back into that. I think I pressed the wrong button. Sorry, I've got a lot of things on my screen which you guys cannot see. There we go. Push that down there. Yeah. So the point here is that this is a very important level here for the US dollar. I think it might actually find a little bit of resistance up here because everyone is saying that Taki Ishii, who's the presumptive prime minister, she'll be acting like a sort of Abenomics, so very expansionary policies, expanding the balance sheet. The BOJ not hiking interest rates, etc., etc. That is possible because she was definitely sort of from the school of Abe, who was in power from you remember from 2013 to 2020. But the point is that yes, the BOJ in that period enormously expanded their balance sheet. They were very accommodative. They were trying to really stimulate the economy. And one can argue that the incoming Japanese prime minister will pursue those policies to a certain degree. But what we have to understand is that back in that period, 2013 to 20, the Japanese actually were suffering from deflation. Or no inflation at all, and so therefore that attempt at sort of QE and sort of reflating the economy was, perhaps even justified. Not at all the situation now. We now have a situation where inflation is a problem in Japan. It's a big political problem. Some people are saying, oh, it's just because of the rice. The rice harvest was poor, therefore the price of rice is up. But the point is that it's a very delicate subject in Japan. The Japanese people historically, the last 20, 30, 40 years have not lived through inflation. They don't like it. It's a politically very sensitive problem. And so the point I'm trying to make here is that I'm not sure how stimulatory the new Prime Minister Takaishi can be, and how much she can put pressure on the BOJ to expand their balance sheet. So all that to say that I think the market is maybe getting a little overexcited here, and we've seen the US dollar sort of strengthen against the Japanese yen. We've also seen the Nikkei sort of push very high, and you can see here that for sure it's been pushing higher, but it's starting to just pause a little bit on the back of that. So it wouldn't surprise me at all just to see if the yen sort of strengthens a little bit, and that the BOJ is not quite as dovish as everyone's expecting, and the new prime minister is not quite as sort of expansionary and stimulatory as everyone is expecting. Okay, just finally, guys, we have a couple of things. We have some Fed speakers today. We have a Bostich, Bowman, and Stephen Miran. Trump's puppet. We'll see what they have to say. But again, the absence of data, it's hard to see, pricing changing too much. And if we actually just look here, let's just have a look and see how the pricing's been going. If we go back to the US here, and we just look at, let's say, December, it's at about 44 basis points. So if we look at the intraday charts, so the very short-term charts here, you can see, let's just go back a little bit here. Go back a couple of days. You can see that over the last few days, it's been fairly stable, but if anything, just a few less cuts being priced in. So the market just sort of grinding a little bit higher. You see, we got down to a low of about 48 basis points priced in, so almost two cuts. We've grinded a little bit higher here, about 3 or 4 basis points. I guess sort of slightly more hawkish there. So not a huge amount of action, just a sort of a slow grind upwards. What we also have got just overnight, just final thing I'll finish with here, is just oil. Let's bring up the oil chart. there were some comments by Deputy Prime Minister in Russia, Novak, who's also in charge of oil, the oil or energy minister. You can see here oil just bouncing a little bit just off this sort of pretty key support level here in the WTI of about $61 or so, but not really strong price action. As I say, if you look at a Fibonacci here, just from this recent impulse here, this is not even a 38% Fib retrace. So at this point, it's hard to call this a strong sort of bounce, more of a, sort of a dead cat bounce, if anything. But the point is that Novak, just on the wires, just out of interest, saying that an increase of more than 137,000 barrels per day was not discussed at the recent meeting. And also Novak said that they did not discuss any further production increases going into November. So take from that what you will, but it seems that OPEC Plus are cognizant of the fact that there are a lot of surpluses starting to build around the world. There's a lot of oil on the water being transported to refining hubs. There's been a lot of talk. You see the curve is moving. It's still in backwardated state, but it's getting flatter and flatter. So the point is that looking out towards oil, especially in the December, January, February, March contracts of 2026, we're really starting to see heaviness in the market. And you can just see here oil, had a little bit of a bounce because that 137,000 barrel increase was less than potentially expected. But oil just finding it a little weak here, and I'm going to be curious to see, what happens over the next, maybe even today, because if that can't get too much sort of traction, you see here the moving average is very, very flat, no real positive energy there, and oil, may want to sort of drift down back towards this $60.50 level, and maybe even a bit further down south, we shall see. Okay, guys, I'll leave it there. As I say, not a huge amount happening today. Markets are fairly quiet. We do have some Fed speakers. We have an auction for the 3-year bond. And of course, let's see if there's any sort of headlines coming out of the Middle East. Thanks very much. Have a great day, and we'll keep this going tomorrow. Thank you.